Welcome to the deep dive. We're looking at a market that's, well, it feels like it's trying to price risk while flying blind.
Yeah, definitely.
We're analyzing what our sources are calling the money pulse. And right now, that pulse seems to be running on, let's say, partial information. It's navigating some pretty significant unavoidable data gaps.
That lack of clarity, that's really the thread running through everything we're seeing, isn't it?
Seems like it.
So our mission today is basically to sift through this pile of sources you've got, covering everything from, consumer budgets to these big corporate integration projects, and pull out the really critical nuggets.
Right.
We want to show you, the listener, exactly what it looks like when serious investors are scrambling for clear signals the broader economy just isn't giving them right now.
You can see that confusion. I mean, just look at the indexes. The market tone is cautious, definitely, but it's also totally divergent.
Completely.
We saw the S&P 500 down over 1%, negative 1.03% to be exact, and the NASDAQ, heavy on tech, fell even harder, negative 1.77%.
But then the Dow Jones...
But the Dow Jones actually finished the day up, positive 0.63%. It's this really strange split. You've got falling stocks overall, but rising crude oil prices.
Which tells you a lot. It signals that these data gaps are forcing investors into very specific sector rotations, probably based heavily on things like energy sensitivity.
So what's the core problem here?
Well, put simply, it's a vacuum. The government shutdown, even a temporary one, it removed clarity on some absolutely critical indicators.
Like what?
We don't have a definitive read on the real state of labor slack, the exact path inflation is taking, and maybe most importantly, the timing of any potential rate cuts from the Fed.
And without that map.
Right. When you lose that fundamental roadmap, investors don't just pack up and go home, they rotate. They're moving towards assets showing real earnings durability, liquidity strength, basically steering clear of anything whose valuation depends too much on hoping for aggressive rate cuts down the line.
Okay, that makes sense. Let's maybe pivot from that macro confusion to something hitting, well, pretty much every household budget. A kind of consumer stress we're calling streamflation.
Ah, yes, streamflation. This is, it's one of the biggest, fastest behavioral shifts we've seen in maybe a decade.
Really? How so?
Well, think about it. Just 10 years ago, the sources showed the typical U.S. household maybe paid, $10 a month for one or two streaming services? Probably early days.
Okay.
The statistic now is pretty staggering. That monthly bill is often north of $35, and the average home is actively juggling 4, maybe 5 different subscriptions.
Well, hold on. $35 a month. That's like 3.5 times the old cost.
Yeah.
And managing 5 services, that sounds exhausting. The sources say cancellations haven't spiked massively yet, but that complexity must be wearing people down.
But that's exactly the point. It's not just the price increase, although that matters. It's become a kind of cognitive tax.
Cognitive tax.
Yeah. We essentially traded one often frustrating bundled relationship with cable for 5 or 6 overlapping contracts, each with different bills, different price tiers, different logins. It's a mess. Honestly, most households probably don't even have a clear idea of how many plans they're actually paying for. And you know what really highlights the problem?
What's that?
The emergence of entire businesses, software services, whose only job is to help you find and cancel your other subscriptions. That tells you consumers are just completely overwhelmed.
Wow. And you see this playing out with the big media companies, right? Disney's recent quarter seems like a perfect example of this stress.
It's a perfect microcosm, yeah. They're stuck trying to fund the streaming future while their legacy business is, shrinking.
How do the numbers look?
Well, it's complicated. On the surface, Disney Plus actually showed some real operational improvement. Revenue was up 8%, operating income up a solid 39%. That looks like success.
Okay, but
then you look at their traditional linear networks, the cable channels, revenue there fell 16%. And operating income plummeted 21%.
Ouch.
Yeah. And that shrinking legacy business was such a drag that the overall entertainment segment's operating income got pulled down a massive 35% year over year. So the market reacted pretty harshly because that streaming win just wasn't big enough to offset the legacy decline.
So bringing this back to our listeners, streamflation is more than just an annoyance when you get your credit card bill.
Oh, absolutely. It's acting like a slow, compounding tax on household discretionary income. And for these media companies, It's a huge stress test.
How so?
They have to figure out how to bundle services smartly, how to price them without causing people to just give up, and how to allocate their capital efficiently, all while consumers are getting increasingly frustrated with juggling multiple apps and logins. It's like they're trying to run a marathon while simultaneously rebuilding the road under their feet.
That's a really strong image. Okay, let's shift now to how companies are responding internally, trying to find efficiencies. Amazon and the grocery business seems like a key area. There's this thing called Project Cremini.
Yes, Project Cremini. This is a really significant operational move. It signals that Amazon is finally truly getting serious about integrating Whole Foods, which, remember, they bought way back in 2017.
So what are they actually doing?
They're basically forcing alignment. They're integrating all, 100,000 plus Whole Foods employees into Amazon's main internal systems, HR, payroll, performance tracking, the works. It essentially gets rid of the separate operational silos that have kind of persisted for years.
But why now? I mean, it's been 7 years since the acquisition. Why go through that huge logistical headache today?
It really boils down to customer lifetime value. The CEO, Andy Jassy, he highlighted that their online grocery customers, they shop more often. And crucially, they return to the main Amazon site at roughly double the rate of people who don't buy groceries there.
Ah, okay, so it's about the ecosystem.
Exactly. If they can standardize the systems, the incentives across the whole grocery operation, they think they can finally unlock that cross-selling and retention flywheel. That was the whole promise of buying Whole Foods in the first place. So the pain of this integration, they see it as the necessary cost to get those margins up.
I see the leverage. Okay, shifting gears again, completely different area. Consumer health. The whole GLP-1 weight loss drug story, Ozempic, Wegovy, that seems to be undergoing a pretty major shift itself, right? Moving away from injections.
That's right. The big story now is the move towards oral formulations, pills instead of shots.
And what's the potential impact there?
Well, it could be foundational for the entire weight management industry. Moving to pills could significantly expand the number of people willing or able to use these drugs, and it could dramatically improve adherence just because, well, taking a pill is easier than an injection for most people.
Makes sense.
And you already see companies trying to capitalize. Weight Watchers is a prime example. They're planning to partner with pharma giants like Novo Nordisk to distribute an oral version of Wegovy, assuming it launches next year.
But wait. Doesn't relying on pills sort of turn Weight Watchers into just like a marketing arm for big pharma? What happens to their old model of community and behavior change?
That's the absolute critical question for their leadership right now. They seem to be repositioning themselves as a powerful distribution and coaching layer that sits on top of these branded medications.
So they're adapting.
They have to. They're basically acknowledging that the drug itself is now the primary driver of the weight loss results. This fundamentally reshapes the economics.
Yeah.
If these pills prove effective and safe long-term, the convenience factor changes everything for insurance payers, too. It creates this pharma-driven ecosystem where Weight Watchers' value might be more about keeping people engaged, providing coaching for adherence, rather than just counting points.
That's a huge shift. Okay, let's move to the tech frontier. The AI debate has definitely matured, hasn't it? It feels like we've gone past the initial, wow, can this thing grow phase.
Yeah, we have.
And now we're hitting the hard reality of who can actually fund this and make money from it sustainably.
And the answer seems increasingly clear, only those with incredibly deep pockets. That capital intensity is probably the single biggest worry for these foundational AI labs like OpenAI.
It's just that expensive.
Astronomically expensive. Building, training, running these frontier models costs a fortune. Our sources point to some really eye-watering numbers, like that reported $300 billion commitment OpenAI supposedly made to Oracle just for cloud infrastructure.
$300 billion. Wow.
Right. That figure alone tells you that playing at the absolute cutting edge is a game only a handful of global tech giants can really afford.
Okay, so you have these massive capital-hungry labs on one side, but the sources also contrast that with more enterprise-focused AI players, right? The ones showing maybe healthier, more cash flow-friendly growth. It sounds like the old picks and shovels idea.
That's exactly the divergence investors seem to be favoring right now, especially in the public markets. Take NICE, for example. They're a mature software company. They reported their AI annual recurring revenue, ARR, was up 49% year over year.
That's strong.
It is, but for them, AI is basically an elegant, high-margin add-on sale to their existing customers. It's an attach rate story. Similarly, look at Celebrate. They do digital forensics tools. They showed solid profits, ARR up 19%, that's steady demand, visible revenue, and it requires relatively less bleeding-edge fundamental R&D.
So in this uncertain climate we talked about earlier, it sounds like predictability is beating potential.
Precisely. Public market investors, operating with that macro caution, they seem to favor these profitable enterprise platforms. The companies selling the tools, the ones with visible recurring revenue streams, they look safer right now than the labs burning through cash, hoping to find the right business model eventually. And that preference will likely continue until the unit economics of frontier AI become undeniably clear and, frankly, profitable.
Let's turn now to the labor market, specifically the service economy. Organized labor seems to be flexing its muscles again. Starbucks was the latest example, wasn't it, with that open-ended strike?
Yeah, over 1,000 baristas involved across, I think, at least 65 locations.
And the timing was key there, wasn't it?
Oh, the tactical timing was brilliant, really. They launched this action on Red Cup Day.
Which is huge for Starbucks.
Exactly. It's traditionally one of their biggest promotional days, drives massive traffic. So hitting them then maximizes the disruption and grabs way more attention than just the number of stores involved might suggest. The core demands were pretty standard fair hours, better wages.
Now, Starbucks has pushed back, saying past strikes like this affected less than 1% of their stores, trying to downplay the operational hit. Does that argument hold water with investors?
It matters, but maybe not in the way they hope. Even if the immediate store-level impact is limited, these kinds of highly visible, strategically timed actions, they absolutely influence the narrative around margin recovery for the entire service sector.
How so?
Well, service brands are already dealing with intense competition, lots of promotions, and fluctuating customer traffic. So when organized labor can effectively disrupt a major event like Red Cup Day, hit your brand consistency like that, it puts real pressure on already tight operating margins. It forces management to address the labor question more seriously at the corporate level, not just store by store.
Got it. Okay, one last quick operational update. China consumer sentiment via JD.com. Their shares popped after results.
They did, up about 5% pre-market, I think. They beat net revenue expectations. Management pointed to strength in electronics, home appliances. And they also emphasized a strategic push into food delivery, showing some targeted growth.
But what's the investor read-through? Still cautious.
Yeah, the overall tone seems to be cautious optimism, leaning heavily on the cautious. While the market rewarded the operational discipline and the beat JD showed they could manage costs, the big picture of geopolitical risk and unpredictable policy shifts hasn't gone away. So investors are likely treating these kinds of rallies as tactical short-term plays based on earnings rather than a sign of a structural long-term recovery in sentiment towards China.
Okay, we've definitely covered a lot of contrasting themes today. We saw that consumers struggle with streamflation versus the big corporate push for efficiency at places like Amazon.
Right, and the huge capital costs of frontier AI versus the sort of steadier, more profitable growth in enterprise software.
And all of this, as we said at the start, is playing out against that macro backdrop where uncertainty is just the default because of those data gaps.
Exactly. And that data vacuum is why the market is so hyper-focused on what's immediately ahead. We're waiting for the October jobs report, and crucially, only the payrolls numbers coming out initially, not the unemployment rate.
Which makes it harder to judge labor market slack.
Significantly harder. Investors have to make bigger assumptions. And that uncertainty just compounds because we're also missing the full CPI picture and other key October indicators. That increases the risk that the market could completely misprice what the Fed might do or not do heading into their December meeting. It really does feel like flying blind sometimes.
And beyond the macro data.
We also need to watch the financial plumbing, so to speak. Keep an eye on that grayscale IPO filing. That'll be a major test of market appetite for crypto infrastructure after all the recent regulatory changes. Grayscale holds a ton of institutional crypto assets, so how that IPO goes is a big signal.
Anything else?
And maybe a bit under the radar but significant, that news about a flagship London prime property development selling at a 50% discount. That hints at potentially deeper liquidity issues or distress in global wealth flows that the market is definitely watching closely.
So it all comes back to this interconnected web, doesn't it? You've got rising pressure on household budgets from things like streamflation. You've got these enormous capital demands from new tech like AI. And you've got critical missing macro data preventing the Fed from giving clear signals.
It's all linked.
Which leads us to the final thought for you, the listener, to mull over. How will that sustained pressure on household spending, that slow squeeze from streamflation, How might that ultimately impact these incredibly capital-hungry business models like Frontier AI, especially if these data gaps continue and prevent the Fed from acting decisively to stabilize things? These aren't separate stories. They're all tangled threads in the same, frankly, messy tapestry right now.
Keep connecting those dots. It's crucial. Until next time.